JP Morgan is speculating that Eurozone stocks may start outperforming US equities. What are your thoughts on that?
Well, first, I think I've basically heard that sentiment every year for the past decade or so. Europe always kind of looks undervalued compared to the United States. Frankly, I think the European Union is a mess of overregulation. I think that it prevents entrepreneurs from building successful businesses, and I think it prevents larger companies from innovating. I don't see anything on the horizon that's going to change that. The other thing I would say is that I don't think it really matters if Europe outperforms. When we look at stocks globally, I think investors are euphoric, and I think that suggests there's going to be an extended bear market. Europe has not outperformed the United States during previous bear markets. If anything, they've underperformed. And again, I don't see anything on the horizon that's going to change that.
European stocks were headed down earlier this week in the midst of declines in the tech sector and financial service shares, and ahead of Q4 wages data that was expected to come out late on Tuesday. Should investors expect more declines going forward, or does the Elliott wave perspective see a change on the horizon?
Well, I'd say in terms of just basic near-term wave structures, things are a little muddy right now depending on which index you look at. If I look at things more broadly, long-term, markets are highly concentrated right now. We all know the Magnificent Seven in the United States, where most of the gains in the S&P are attributed to 7 stocks. That's actually down to probably 2 or 3 stocks now. But there's a lesser-known version of this going on in Europe, where the 5 largest companies in the DAX are responsible for like 80% of the movement in the DAX over the last decade. So we view concentrated markets as dangerous markets, and I think it's just one more example where significant change is on the horizon.
The UK has officially entered recession territory, seeing negative growth for the past 2 consecutive quarters. Is this a temporary dip, or do you expect it to continue? And do you see the rest of Europe following suit, or is this limited to the UK?
Yeah, I don't think this dip is temporary. I think the economic weakness we're seeing is symptomatic of stock indexes that are slowly rolling over into decline. The FTSE 100, if you look at a chart, it's no higher today than it was in 2018, 6 years ago. Europe, the picture's a little more muddy. Some stocks are at new all-time highs. Some indexes are at new all-time highs, and some aren't. The good thing about forecasting the economy is that we can use the stock market to do it. So if stocks mount a significant rally from here, I don't necessarily expect that. But if they do, the economy is going to improve. If stocks sell off from here, then the economy is going to continue to contract. All we really need to do to make highly accurate forecasts on the economy is to know the direction of stocks.
What can we expect from interest rates in Europe's biggest markets?
Yeah, big picture on rates is that we're in some sort of downward correction right now. I don't think we are going back to zero interest rates. We're certainly not going back to negative rates. And this does have pretty big implications. I mean, if you look at that rise in rates from 2020 to 2023, I mean, that had significant impacts, right? Credit Suisse, we lost Credit Suisse during that rise. We lost a bunch of regional banks in the United States. That, from a wave perspective, is wave 1. So after this correction, we've still got several more legs of increasing rates to come. And I think the implosions that come with those increasing rates will actually be more dramatic than what we saw before.
What's the one thing European investors need to know right now?
I would say that now is the time to play defense. I know that's not the popular opinion, but now is not the time to FOMO into NVIDIA. It's not the time to get super excited about US tech. I think, like I said, markets are overvalued. Investors are euphoric. And now is actually the time to be defensive. Cash, and safe cash equivalents. You want to have dry powder when the bargains come, and we think they're coming.
To get our current charts and analysis for the European region, consider subscribing to our European Financial Forecast service today. All month long, we give subscribers tradable insights into the area's key markets, as well as psychology powering the region's big trends and turns with Brian Whitmer's European Financial Forecast and Murray Gunn's European Short-Term Update. Go to elliottwave.com to learn more. Thank you for watching.